The U.S. markets are currently closed. UiPath Inc., ticker symbol PAT, closed the last trading session at $15.58 per share, marking a significant intraday gain of 0.76 or 5.13%. Now, on the surface, a 5% pop in a single day seems like a reason for celebration. It's the kind of green number that investors using the Robinhood app or checking their Fidelity mobile app love to see. The immediate expectation is that something good must be happening, perhaps a positive analyst note, a new partnership, or a sign that the worst is finally over for this beleaguered automation software company. But that's where expectation and reality violently diverge. This 5.13% jump isn't a signal of newfound strength. It's a flicker of life in a stock that has been fundamentally broken by the market. To view this as anything more than a volatile twitch in a long-term downtrend is to completely miss the brutal reality of UiPath's current situation. This isn't the beginning of a recovery. It's more likely a momentary pause in a painful and necessary reevaluation of what this company is actually worth. Let's ground ourselves in the recent price action, because the story is written in these charts for anyone willing to look past a single day's performance. This recent move to nearly $16 is happening on relatively average trading volume. There's no massive surge of institutional buying suggesting a conviction-driven shift in sentiment. Instead, it feels more like short covering or a passive lift from a slightly better day in the broader tech sector. The stock is simply bouncing off a technical support level around the 14 to 15 range, a floor that was established after the stock fell off a cliff just a few weeks ago. The real story isn't the 5% gain. It's the cataclysmic 34% drop that happened in a single day at the end of May. That was the moment of truth. That was when UiPath reported its earnings, and the facade of a stable, high-growth enterprise software leader was completely shattered. The expectation was for another quarter of steady, predictable growth. The reality delivered was a shocking revenue miss, a drastically slashed full-year guidance, and the abrupt resignation of its CEO, Rob Enslin. That earnings call was one of the most disastrous moments for a public company in recent memory. Management spoke of deal fatigue and a challenging macroeconomic environment, causing customers to hesitate on large multi-year automation contracts. They admitted to significant sales execution challenges. For a company valued on its ability to grow rapidly, this was a death sentence. The market's reaction was not an overreaction. It was a logical repricing based on a complete loss of faith in management's ability to forecast its own business. So when we see a 5% bounce today, it's critical to understand it's a bounce from $15, not from the $25 or $30 level where it was trading just a few months ago, let alone the absurd 80-plus highs it saw after its IPO. Investors managing their portfolios on platforms like Interactive Brokers or using services like Schwab Intelligent Portfolios had to watch as billions in market capitalization evaporated overnight because the company's narrative fell apart. This isn't a growth story like Nvidia stock or a stable behemoth like Apple stock. It's a turnaround story at best and a value trap at worst. The institutional activity tells an even more revealing story. For a long time, UiPath was a darling of growth-oriented funds. Cathie Wood's ARK Invest was a major proponent, holding a significant position and championing the company's role in the future of work. However, following the earnings collapse, ARK and other institutions were seen trimming or outright dumping their shares. The trust has been broken. When institutions, the so-called smart money, run for the exits, it creates immense overhead supply. This means that every time the stock tries to rally, there are scores of bag holders who bought at higher prices looking for an opportunity to sell and get out with a smaller loss. This is why small relief rallies like the one we just saw often fail to gain momentum. They run into a wall of sellers. Any serious online investment analysis must account for this broken market structure. You have to ask yourself, are new buyers coming in with fresh conviction, or is this just the churn of old disillusioned investors leaving? Right now, the evidence points overwhelmingly to the latter. Let's briefly touch upon what UiPath actually does for those who might be less familiar. The company is a leader in a field called robotic process automation, or RPA. Essentially, they create software bots that can mimic human actions to perform repetitive digital tasks, things like processing invoices, migrating data, or filling out forms. It's a powerful technology that promises to increase efficiency and cut costs for large enterprises. Their platform has expanded to incorporate more advanced AI and machine learning capabilities, positioning them as a comprehensive automation solution. The business model is primarily subscription-based, which should, in theory, lead to stable recurring revenue. The key metric for a company like this is its annualized renewal run rate, which represents the contracted recurring revenue. The severe guidance cut was centered on a much slower growth projection for ARR, signaling that their core business engine is sputtering. The central conflict for UiPath is that its technological leadership is no longer enough. The expectation was that being the best-in-class RPA provider would guarantee success. The reality is that they operate in an increasingly crowded and competitive space. The single greatest threat comes from Microsoft with its Power Automate platform. Microsoft is bundling its automation tools into its broader Office 365 and Azure ecosystem, often at a much lower price point or even as a free add-on. For a CFO scrutinizing every line item on their IT budget, it becomes very difficult to justify a premium-priced standalone platform from UiPath when a good enough solution is already included in their existing Microsoft Enterprise agreement. This is a classic case of a dominant ecosystem commoditizing a niche market. UiPath's argument is that their platform is more powerful, more scalable, and better suited for complex enterprise-wide automation. While that may be true, the market is proving that for a large number of use cases, Microsoft's offering is sufficient. This competitive pressure is a permanent headwind that isn't going away. So, where does the stock go from here? This is where an investor looking for investment help has to weigh two competing scenarios. The bull case, the optimistic path forward, rests entirely on the shoulders of the returning CEO and founder Daniel Dines. The narrative here is that the sales execution problems were a temporary issue under the previous leadership. Dines, as the founder and technical visionary, can come back in, right the ship, refocus the company on product innovation, and restore trust with customers and investors. The argument is that with expectations now reset to a much lower bar, the company can begin to underpromise and overdeliver. If they can stabilize ARR growth and show a clear path to sustained profitability, the stock, trading at its current depressed multiples, could be significantly undervalued. A risk-tolerant investor making a self-investing decision might see this as a classic turnaround play, similar to betting on a fallen giant. But the bear case is equally, if not more, compelling. The reality might be that the problems are not temporary. The sales execution issues could be a symptom of a saturated market and intense competition. The macroeconomic pressures might persist, leading to longer sales cycles for the foreseeable future. In this scenario, the company struggles to re-accelerate growth and the stock becomes dead money, trading sideways for years as the market waits for proof of a turnaround that never quite materializes. The risk is that UiPath becomes a cautionary tale, a company with great technology that failed to build a durable business moat around it. It would not be the first. Many investors who manage their own portfolios through a Fidelity brokerage account or trade actively on Interactive Brokers have seen this story play out before. Comment below what you believe is the biggest challenge for UiPath's new CEO. Is it the external threat of competition from Microsoft, or is it fixing the internal sales and go-to-market strategy? I'm curious to see what you all think is the more pressing issue. In closing, it's essential to look at UiPath with a clear, unbiased perspective. The 5.13% rally that caught everyone's attention is, in the grand scheme of things, just noise. The market's expectation for UiPath was that of a dominant, high-growth leader in a burgeoning industry, a peer to names like Tesla stock in terms of its disruptive potential. The reality, delivered in a brutal quarterly report, is that of a company facing a potential existential crisis. It is battling fierce competition, a difficult economic backdrop, and a complete breakdown in its sales engine, leading to a crisis of confidence among the investment community. The path forward is